A financial bubble is one of those concepts that sounds simple on paper, but becomes surprisingly emotional and chaotic in real life. At its core, a financial bubble happens when the price of an asset, stocks, real estate, crypto, or even collectibles, rises far above its real economic value, driven not by fundamentals, but by hype, speculation, and the belief that someone else will pay more tomorrow. And the most dangerous part? Bubbles don't feel like bubbles while they're forming. They feel like opportunity. That's why even intelligent investors, institutions, and entire governments get caught in them repeatedly. The simple definition. A financial bubble is a rapid increase in asset prices, followed by a sudden collapse when reality catches up with speculation. But that definition hides the real story. Because bubbles are not just economic events, they are psychological cycles that involve greed, fear, social behavior, and collective belief. To understand them properly, you need to understand not just markets, but human behavior inside markets. The anatomy of a bubble. Every bubble, regardless of era or asset type, tends to follow the same pattern. 1. The displacement. Something new appears. A bubble usually begins with a real innovation or shift, a new technology, a new financial instrument, a new market opportunity, or a major economic change. For example, the Internet, .com bubble, low interest rates, housing bubble, blockchain technology, crypto boom cycles. At this stage, things are rational. The excitement is justified, but it sets the stage. 2. The boom. Early investors profit. Early adopters begin making money. Prices start rising. This creates a powerful signal. This works. I should pay attention. Institutional investors enter. Media coverage increases. Public awareness grows. Importantly, prices are still partially grounded in reality, but expectations are expanding faster than fundamentals. 3. The euphoria phase. Reality detaches. This is where things become dangerous. Prices stop being driven by value and start being driven by belief. Common signs. This time is different. Thinking extreme optimism, rapid price acceleration, people investing without understanding the asset. At this stage, the asset is no longer just an investment. It becomes a story. And stories spread faster than data. This is where bubbles become self-reinforcing. 4. The peak. Nobody knows it's the top. The top of a bubble is rarely obvious in real time. Instead, it feels like new normal. Pricing, widespread confidence, media celebration, fear of missing out, FOMO, dominating decisions. Everyone believes prices will continue rising indefinitely. But beneath the surface, the only thing holding prices up is new money entering the system. Once that slows, the structure weakens. 5. The crash. Reality returns abruptly. Eventually, something breaks the illusion. Interest rates rise, earnings disappoint, liquidity dries up, or confidence shifts. Once selling begins, it feeds on itself. Why? Because in a bubble, prices are supported by expectations, not intrinsic value. So when expectations reverse, there is little structural support. Prices fall quickly, often violently. 6. The panic and aftermath. The crash transitions into panic, forced selling, margin calls, liquidity shortages, bankruptcies in extreme cases. Then comes the slow recovery phase, where the market tries to rebuild on actual fundamentals again. But trust takes time to return. Why do financial bubbles keep happening? You might think that after centuries of financial history, humans would learn. But bubbles repeat because they are not just financial mistakes, they are psychological inevitabilities. Here's why. 1. Humans extrapolate the recent past. When prices rise, people assume they will keep rising. This is called recency bias. If something has gone up for 12 months, the brain starts treating that trend as permanent, even though markets rarely move in straight lines. 2. Fear of missing out, FOMO. Bubbles are socially contagious. When people see others making money, they don't want to be left behind. This creates a herd effect. It's not just, this is a good investment. It becomes, everyone else is doing it. I can't sit out. 3. Easy credit fuels speculation. Low interest rates and abundant liquidity make borrowing cheap. That money often flows into assets instead of productive investment. This amplifies price increases far beyond fundamental value. 4. Narratives overpower data. In bubbles, stories become more powerful than numbers. Examples: this technology will change everything. Housing always goes up. This asset is the future of money. Narratives simplify complexity. That makes them highly persuasive, even when they are incomplete. 5. Incentives reward participation. Fund managers, traders, and companies often get rewarded for short-term performance, not long-term stability. So even skeptics may join bubbles to avoid underperforming peers. Famous financial bubbles in history. The dot-com bubble. In the late 1990s, internet companies skyrocketed in value even if they had no profits. The idea wasn't wrong, the internet was transformative, but prices became detached from reality. Eventually, the bubble burst, wiping out trillions in market value. Today, major survivors like large tech firms still dominate the industry, but many speculative companies disappeared entirely. One major benchmark during this era was the Nasdaq Composite Index, which experienced extreme volatility during the boom and crash. The housing bubble, 2000s, easy credit and risky lending practices led to soaring real estate prices. People believed housing prices would always rise. When mortgage defaults increased, the system collapsed, triggering the global financial crisis of 2008. This event showed how deeply interconnected financial bubbles can be with the real economy. Crypto cycles. Cryptocurrencies have experienced multiple boom-bust cycles, driven by innovation, speculation, and narrative shifts. While the underlying blockchain technology remains significant, many price surges have been driven by speculation rather than adoption. What a bubble is not. A common mistake is thinking, if prices fell, it must have been a bubble. That's not always true. A bubble is not defined by a crash, it is defined by overvaluation, driven by speculation rather than fundamentals. Markets can fall without being bubbles, and bubbles can exist without immediate crashes. The psychology of a bubble, why it feels like opportunity. One of the most fascinating things about bubbles is that they feel good while they are happening. They create excitement, optimism, social validation stories of quick wealth. Even cautious investors feel pressure to participate. This is why bubbles are not just financial phenomena, they are emotional ecosystems. The aftermath. What bubbles actually leave behind. Even though bubbles crash, they don't leave nothing behind. They often accelerate real innovation. The dot-com bubble helped build modern internet infrastructure, housing expansion, reshaped cities, crypto cycles pushed blockchain development forward. So, paradoxically, bubbles can destroy capital while still advancing technology. They misallocate resources in the short term, but sometimes leave long-term infrastructure behind. Can you identify a bubble in real time? This is one of the hardest questions in finance, and also one of the most misunderstood. In reality, the uncomfortable truth is this: you rarely know you're in a bubble while you're inside it. That's because bubbles don't announce themselves as bubbles. They show up as opportunities, new eras, or once-in-a-generation trends. By the time the warning signs feel obvious, the market narrative is usually too strong to question. Still, some signals can suggest things are getting stretched, but they're rarely clear enough on their own to confirm anything in real time. Common warning signs, but not guarantees. When bubbles start forming, certain patterns often appear together. Prices rising far faster than earnings, adoption, or real usage. When valuation growth completely disconnects from actual economic output, speculation is usually doing more work than fundamentals. Widespread participation from inexperienced investors. When people with little understanding of the asset class start entering in large numbers, it often signals late-stage enthusiasm rather than early-stage discovery. Excessive leverage in the system. Borrowed money amplifies both gains and losses. When leverage becomes widespread, markets become fragile. Small shocks can trigger large reactions. This time is different narratives, one of the strongest psychological red flags. It usually signals that traditional valuation logic is being ignored or redefined. Rapid media attention and social media amplification. When financial excitement turns into cultural momentum, price movements start feeding on attention rather than fundamentals. The real problem: signals don't act alone. Individually, none of these signs prove a bubble. Even together, they don't guarantee one. That's what makes bubbles so difficult to navigate in real time. High valuations can sometimes be justified by genuine innovation. Rapid adoption can reflect real structural change. Media hype can follow real technological breakthroughs. In other words, the same signals that appear in bubbles can also appear during legitimate long-term growth phases. The key lesson about financial bubbles. A financial bubble is not just a market failure, it is a collective belief system that temporarily overrides economic reality. It happens when optimism becomes excessive, risk is underestimated, and belief replaces analysis. And because human behavior doesn't change, bubbles will continue to appear in new forms, even in future technologies we haven't seen yet. Final thought. Financial bubbles are not just about money. They are about how humans behave when something new appears. Prices rise quickly and everyone believes they can't lose. The tragedy of bubbles is not that people don't understand math. It's that they understand emotion more strongly than math when money is involved. And emotion, in markets, is often the strongest force of all. If you want to really understand financial bubbles, don't just read about them, observe them. Ask yourself, are prices rising because of real value or expectation? Are new buyers entering mainly because prices are rising? Would I still buy this if no one else was talking about it? Write your answers down and revisit them monthly. Because the best defense against bubbles isn't prediction, it's awareness. And awareness turns you from a passive participant in financial cycles into someone who understands them while they're happening. Like, subscribe for more. Thanks for watching.